This is one of those bank account topics where I think people hear one number and then they accidentally do the exact wrong thing, and the number is $10,000. You have probably heard some version of this before. If you deposit more than $10,000, the bank reports it. If you withdraw more than $10,000, the bank reports it. And then the internet turns that into the IRS is watching your bank account. That is not really the clean version. The cleaner version is this. The rule is about cash, actual currency, cash and coins. And the report is usually a CTR, a currency transaction report, filed with FinCEN, which is inside the Treasury Department. It is not a report that says you did something wrong. It is not a report that says your money is illegal. It is just paperwork banks have to file. When one person has more than $10,000 in cash transactions in one business day, so if you sold a car for $12,000 and the buyer handed you cash, and you walk into the bank and deposit the full $12,000, that is not the scary part. Honestly, that is the normal part. The dangerous part is what a lot of people do after they learn the rule. They think, okay, I will deposit $6,000 today and $6,000 next week, or I will use two different branches, or I will put some in my account and some in my wife's account. That is the mistake, because breaking up cash transactions to avoid the reporting line is called structuring, and structuring is treated much more seriously than the clean $12,000 deposit. So the first move is very simple. If the cash is legitimate, do not play games with the number. Deposit it normally, keep the paper trail, sale receipt, inheritance letter, gift note, closing statement, whatever explains where it came from. The report is routine. Trying to dodge the report is what makes the whole thing look worse. Now, the second move is understanding what does not count. The same way, a lot of people hear the $10,000 rule and they start thinking every large transaction is the same. A wire transfer, a personal check, a cashier's check, a transfer from brokerage to checking. But these are not all treated like walking in with a paper bag of cash. So, for example, IRS Form 8300 is a rule for businesses that receive more than $10,000 in cash in a trade or business, and even there, the definition of cash has details. Personal checks are generally not cash. For that rule, a wire from a financial institution is not cash for that rule. So to be clear, large non-cash transfers can still make a bank ask questions. They can still need documentation. They can still have tax consequences depending on why the money moved. But do not blur every large transaction into one scary IRS bucket. The move is know what kind of transaction it is. Before you react, cash is one category, wires are another, checks are another, sale proceeds are another, gifts are another, and the more unusual it is for your account, the more I would want documentation ready before the money moves. Now, the third move is about SARs, suspicious activity reports, and this is where people get uncomfortable because the dollar amount is not. And the whole point, a bank can report suspicious activity when a transaction looks relevant to a possible violation of law or regulation, and federal law also limits what the bank can tell you about that kind of report. So you may never know whether a suspicious activity report was filed, but I do not want you to hear that and panic, because the practical lesson is not live scared of your bank account. The practical lesson is do not surprise the bank with a story that has no paperwork. If you have taken out $300 a week for years and then one Friday you walk in and ask for $8,000 cash, that may be perfectly legitimate, Maybe the roof needs repairs. Maybe you are helping a grandchild buy a car. Maybe a contractor wants a deposit, but to the system, it is a pattern change. So what do? You bring the context, you bring the invoice, you bring the contractor estimate, you bring the sale agreement, you call the branch first and say, I am planning a larger withdrawal. On Friday, here is the reason. What documentation would you like me to bring? That is not begging permission to use your own money. That is just reducing confusion before the confusion starts. Now, the fourth move is for older account holders especially. There are rules and industry procedures around financial exploitation of older adults. In the brokerage world, FINRA Rule 2165 talks about specified adults, including people age 65 and older, and it allows a temporary hold. When a firm reasonably believes financial exploitation has happened or may be happening, that does not mean every bank in America has a brand new rule that freezes every senior's account for no reason. That is too broad, but it does mean financial institutions are more sensitive to large withdrawals, new recipients, family pressure, romance scams, contractor scams, and sudden requests that do not match the customer's normal life. And honestly, and that protection exists for a reason, older Americans lose serious money to fraud every year. So I am not against the protection. I just think you should know how to make your real transaction look like a real transaction. One thing I would do is add a trusted contact, not a joint owner, not someone who can take your money, just a person the bank or brokerage can call if they are worried something is off. Maybe your daughter, maybe your brother, maybe a close friend, someone steady. And before any large, unusual move, call ahead, say what is happening, ask them to note it, ask what form of ID or paperwork they want. That one boring call can sometimes save you from a very long week. Now, the fifth move is checking your FDIC coverage before you need it. Most people know the number $250,000, but the part they miss is per depositor, per insured bank, per ownership category. So it is not just one account equals $250,000. It depends on how the account is owned: single account, joint account, retirement account, certain trust or payable on death setups. And this matters because some retirees keep years of savings inside one checking or savings account. Maybe they sold a home. Maybe they are nervous about investing. Maybe they just like seeing the money in one place. I understand that. But if the balance is above insured limits, you do not want to discover that during a bank failure. So the move here is not complicated. Use the FDIC's insurance estimator or sit down with the bank and ask them to show you what is insured and what is not. And if you are over the limit, do not just open 5 random accounts without understanding ownership categories. Ask clearly, is this covered separately? Is this the same ownership category? What happens if this bank fails? It is a boring question, but boring questions are usually where the money gets protected. Now, the sixth move is probably the one families mess up. With the best intentions, adding an adult child as a joint owner, and I get why people do it. Mom is getting older, dad passed away, someone needs to help with bills. The bank employee says, you can just add your son or add your daughter. It feels easy, but easy is not always clean. A joint owner may have real legal access to the money. Their creditors may become your problem. Their divorce may become your problem. Their tax lien may become your problem. And when you die, a joint account with survivorship may pass straight to that joint owner. even if your will says everything should be divided equally. That is where siblings start fighting. Not because the parent was trying to cause a fight, but because the bank form did something different than the family story. So before you add a child as joint owner, slow down. Ask about alternatives. A payable on death beneficiary, a transfer on death registration for brokerage assets, a durable power of attorney, drafted correctly, a limited convenience signer. If the bank offers it, the right answer depends on your state, your family, and the account type. But the question is simple. Do I want this person to help me, or do I want them to own this money? Right now, those are not the same thing. Now, the seventh move is what to do with money. That is just sitting there. I'm not saying every dollar needs to be invested. For a lot of retirees, cash is peace of mind. And honestly, having cash available is not a weakness. But there is a difference between 3 to 6 months of living expenses and a huge idle balance that is earning very little, sitting above insurance limits, and creating more questions every time you move part of it. So I would separate the money by Job: checking account for monthly bills, savings account for emergencies, maybe a high-yield savings account, or CDs for money you need soon. And for some people, Treasury bills can make sense. For extra cash they do not need. This month, Treasury bills are backed by the U.S. Treasury. They can have short terms, as short as 4 weeks. The minimum purchase through Treasury Direct is $100, and the interest is federally taxable, but generally not subject to state or local income tax. Now, that does not mean Treasury Direct is perfect for everyone. The website can feel clunky. You need to understand maturity dates. And if you need instant access, you probably do not want every dollar tied up there, but the broader point is useful. Do not let all your money sit in one account just because it feels simpler. Simple can be good. Too simple can create blind spots. So if I had to bring the whole thing down to one checklist, it would be this. 1, if you have a large cash deposit or withdrawal, do it cleanly and keep proof. 2, do not split cash transactions just to stay under $10,000. 3, before unusual transactions, bring the story on paper. 4, add a trusted contact, especially if you are older or helping an older parent. 5, check FDIC coverage by ownership category, not just by account number. 6, be very careful with adult children as joint owners. 7, give every dollar a job instead of letting one big balance sit there forever. And I want to be clear about the tone here. This is not about hiding money. This is not about avoiding taxes. This is not about outsmarting the bank. It is the opposite. It is about making your money easy to explain, easy to document, easy to insure, and easy for your family to understand. If something happens to you, because most bank problems do not start with a criminal mastermind. They start with a normal person who does not know the form, does not keep the receipt, adds the wrong name to the account, or breaks up cash because they thought that looked safer. So this week, pick one thing, run your FDIC coverage, add a trusted contact, check who is listed on your accounts. Or if you are about to move cash, collect the paperwork before you move it. One small boring step now is a lot easier than trying to explain a confusing transaction later. And if you know someone over 65 who keeps most of their savings in one account, send this to them, not to scare them, just so they ask better questions before the bank form does the thinking for them.